Hello, everyone. I think I found something that correlates almost directly to knowing about the faulty mortgage loans in the 2007-2008 crash, but in today's era. So, without further ado, we're just going to jump right into it because I got a lot to show you today. So, it all stems from bonds, like it always does, right? Right now, we are in a very volatile era, we'll kind of see, and an era that loves risk. And that had a lot of benefits before the pandemic, before the inflation numbers started to come in. But now this risk is getting hit pretty hard. Okay. So we had very low interest rates for quite some time, nearing zero. Um, and this led to people wanting fatter yields. This led to investors wanting fatter yields. And so what these people on Wall Street did, is they did their thing and they created a series of complex products that spun extra basis points out of comatose markets, essentially like dead markets, low yield markets. Now, now that we saw this volatility spike, they've been scrambling to hedge their positions, piling into derivatives that benefit from higher volatility. So we saw low volatility for so long that they put these places in to create false volatility. Now that we have real volatility spiking, the false volatility triple folds, right? Quadruple folds. It's like doing margin essentially. It's like investing with margin, but if you are a hedge fund or something like that. So it's a whole nother level. Um, so yes, in that process, they're adding fuel to the fire. Um, that's already sent one measure of rates volatility to near the highest level since the global financial crisis, like I talked about earlier, outpacing the violent swings in both stocks and currencies. So bonds are outpacing stocks in volatility, which should essentially never happen. Which kind of gets me thinking like this doesn't happen very often, and I really think this could be along the lines of 2007, 2008 in the sense that like we're kind of getting a little head start on this thing. We'll see how this kind of plays out, and we'll read into the article a little further. But essentially, yes, it's just to multiply the chance at quick scores and, of course, quick losses, right? So for some, it's prompting concern that structural positions are less sturdy in a $24 trillion government bond market. $24 trillion market, the bond market, biggest market, essentially. And we saw this not too long ago, actually, very not too long ago, in the UK. The UK struggled with their gilts sell-off last month and their bonds, and this sent yield prices skyrocketing and really messed them up, really messed up the economy. And it says here it could trigger unforeseen consequences, not unlike how the UK had to deal with it. But it probably won't be the same. Probably won't be the same. And yeah, so it all stems from low rate, low volatility environment in the past getting flipped on its head, and now it needs to be hedged. So here we have, the chart, the MOVE index, which is essentially just a bonds volatility index, and the VIX index, which is a stock volatility index. First of all, I'd really recommend getting the VIX index on your radar if you're interested in trading stocks or any of that. Very, very beneficial in kind of finding bottoms, finding tops. Think of it kind of like the RSI, oversold indicator. Anyway, um, right here we see the bonds volatility index rising over this last year, while the VIX is staying relatively flat and kind of respecting its past trends, its past price action. And that's very interesting because normally we like to see, right, if we just kind of like forget about that, normally we see like in these little spikes, the VIX outpacing the move by quite some large percentage. So this is kind of unprecedented, and it could lead to some very interesting things happening in the market. I'm just glad we get to know it beforehand. It says prompted investors to lessen their bond risk by buying derivatives, short maturity options on interest rate swaps. That was in the past. That was these like short maturity options were a couple months ago. Now they have to hedge their position and find long volatility bets, right, to hedge their own exposure. So we've had the short maturity options priced into the market. So we don't need to think about that too much. What we do need to think about is how they need to hedge their bets and buy long volatility options that kind of like the volatility in the market and are also long for the market. So where do we find those? So you can find those long volatility options in corridor bonds or fairway bonds. We'll talk about those in just a second. But another reason is higher rates, right? So we have hundreds of billions of dollars of volatility-driven products that are exacerbating the swings. Simply put, side bets on ups and downs, right? Basically day trading the bond market, interesting, right? Because people are desperate for returns. And right, it was seen as a sure thing for quite some time until it wasn't, until inflation numbers started coming in, until 75 basis point hikes were normal. And investors are sitting on deep losses. And banks are coming out on top. So when did we see that last? When did we last see investors sitting in deep losses and banks coming out on top? 2007, 2008. So it's very similar, I think. It's where we have these banks who were supposed to do certain things to hedge themselves, to hedge the people, to hedge the investors, and they didn't really do it. And now they're coming out on top again. And so it's very, very fascinating to see kind of what's going to be put in place again. Because we've kind of seen this before where, they're too big to fail. And if you watch The Big Short or just know about 2008, you kind of know. But it's very interesting. We see a very similar pattern here where banks are winning and investors are losing. So yes, what does this do? This forces investors to position against even higher volatility. Dealers have to buy volatility, and that is never good. Once you start having to hedge with more volatility, that's like the worst thing you could do is hedge volatility with volatility. But that's statistically the right way to do it. And so here it is. Here it is. There's a lot of stuff that has happened that makes me believe we are already on the pre-sipe of a free fall. The precipice of a free fall. Okay. 2008, question mark. Not even a question mark, or is it? So we see things that are similar to 2008. We have people saying that we are on the edge of a free fall, and we have banks winning. I could see 2008 happening again. I don't know about you guys. So we're just going to speed run through some things really quickly. Corridor notes and fairway bonds are essentially betting on interest rate levels, federal fund rate levels. And yes, very volatile driven levels. And with the recent 75 basis point moves, very, very volatile, right? And so with all these hedges that were going on, the options they had sold became the problem. The hedges were the problem. Hedges are supposed to make you a couple percentage opposite of what you're losing. But they were losing more on the hedges than they were making on the long volatile exposures. So the dealers started buying more volatility, and we just see this feedback loop that is just eating itself, absolutely eating itself, right? Supply has dried up, demand has gone up, uncertainty is in the air. Who really knows kind of what's going on? But I find this very interesting. I could see this being a 2007, 2008 type thing, and I just hope we get to look back at this video and say, yeah, right. We had all the numbers right here. We had the news, and we played our cards right and came out on top. So I hope you guys can do the same. Peace. Thank you. Bye.